Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines.
All right, it's time for our deep dive, into the latest news from CNBC, the Wall Street Journal, Bloomberg, and CNN.
Got to stay informed, right?
Got to stay informed, giving you the insights you need to start your week off right.
Okay, so what's the big story making waves this morning? What's got, people talking out there?
Well, we've got some unexpected election results out of Japan. The ruling LDP party
Oh, yeah?
lost its majority.
Okay.
And the Nikkei topics are actually climbing because of it.
Interesting. So why are the markets reacting positively to this political shakeup? It seems a little counterintuitive, doesn't it?
And you're right, got it. Yeah.
You would think uncertainty, would lead to a drop. But
Yeah.
here's why CNBC is suggesting that this uncertainty might make the Bank of Japan hesitant to raise interest rates.
Okay.
This could lead to a weaker yen, which would benefit Japanese exports and potentially boost the stock market. So investors are betting on a weaker yen. Does that mean they were expecting this election outcome?
Well, Bloomberg reported that hedge funds were already selling yen before the election,
Wow.
possibly anticipating this outcome.
Interesting.
It seems like some people were definitely ahead of the curve on this one.
Wow. Talk about reading the tea leaves.
Yeah.
Now, on a completely different note, let's talk about oil prices.
Okay.
The Wall Street Journal reported on Israel's airstrikes on Iran over the weekend. How is that impacting the markets?
Initially, oil prices spiked on fears of disrupted supplies.
Right. Yeah. Makes sense.
However, CNBC is reporting a sense of relief now that it's clear the strikes avoided energy facilities.
Okay.
Prices are dropping sharply, over 6%, in fact.
So the market overreacted to the initial news.
It seems that way.
Okay.
Remember, oil prices often include what we call a risk premium.
Right.
Essentially, when there's a potential threat to supply, that risk gets factored into the price.
Yeah.
Now that the situation seems less volatile, that premium is evaporating.
Okay, that makes sense. But it sounds like there's more to this story than just geopolitical tensions, right? Didn't we see a report on falling oil prices just last week?
Right. There's also a global oversupply issue at play.
Okay.
Bloomberg reported increasing oil production,
Yeah.
not just from major players like the U.S. and Canada, but also smaller countries.
Okay.
This oversupply was putting downward pressure on prices even before the airstrikes.
So it sounds like this dip in oil prices could be more than just a blip on the radar.
That's certainly a possibility worth considering.
Yeah.
Now let's shift gears and talk about the upcoming U.S. presidential election.
Right.
The Wall Street Journal is highlighting economists' concerns about potential inflation hazards,
Inflation.
particularly with Trump's proposed policies.
Here's where it gets interesting. Trump's platform includes policies like tariffs and immigration restrictions that could have a real impact on inflation, right?
Exactly. Economists are worried that these policies could disrupt global trade and potentially lead to higher prices for consumers.
The Wall Street Journal mentioned tariffs specifically. Can you explain how those might impact, say, the average person listening right now?
Think of tariffs as a tax
Okay.
on imported goods.
Right.
They can increase the price of everything from car parts to electronics.
Yeah.
Essentially, they make everyday items more expensive for consumers.
Okay, so tariffs could really hit people's wallets. That makes sense. But beyond the impact on consumers, how could the election impact the stock market overall?
Well, the Wall Street Journal pointed out that the election outcome could create volatility, especially for companies reliant on global trade.
Right.
If protectionist policies are implemented, those companies could face significant challenges.
That's something for investors to keep in mind as we get closer to the election. Now, CNBC is reporting that U.S. Treasury yields are climbing. What's driving that trend?
It could be a reflection of a more resilient economy and a decreased likelihood of future interest rate cuts. The interesting thing is CNBC noted that the Treasury Department has been holding debt sales steady, but that might not be sustainable in the long run.
Hold on, can you explain that? What does it mean that the Treasury is holding debt sales steady?
Essentially, the U.S. government regularly issues debt to finance its operations.
Right.
This debt comes in various forms,
Right.
including Treasury bonds.
Okay.
When the Treasury sells more bonds, it's borrowing more money.
Right.
If they keep those sales steady, they are essentially trying to control how much new debt they are taking on.
Okay, I'm following you.
Yeah.
So is there a chance the Treasury might increase those debt sales down the line?
It's possible, especially considering the large fiscal deficits we're currently running.
Yeah.
The upcoming quarterly refunding announcement will give us some clues, but the looming election adds a layer of uncertainty to the situation.
It sounds like we'll have to wait and see on that one. Now let's talk about McDonald's.
Okay.
CNN is reporting on an E. coli outbreak linked to their quarter pounders. Not exactly the kind of headlines you want to see if you're McDonald's, right?
Definitely not. They've been struggling to win back customers after price hikes.
Right.
And this outbreak is a major setback. Their stock took a hit last week.
This reminds me of Chipotle's E. coli outbreak a few years back.
Yeah.
They really struggled to regain consumer trust after that. Do you think McDonald's could face a similar situation?
It's hard to say for sure. CNN pointed out that the impact of these outbreaks can vary widely.
Okay.
Chipotle took years to recover,
Yeah.
but Wendy's bounced back relatively quickly from a similar incident in 2022.
Right.
It really depends on how McDonald's handles the situation.
So transparency and quick action are key here.
Absolutely. Consumer perception is everything in these cases.
Okay.
Moving on, Bloomberg is reporting that Boeing is planning a massive share sale to raise capital.
Wow.
That's a pretty big move. What's driving that decision?
Yeah.
Well, the ongoing worker strike has severely impacted Boeing's production, especially for their 737 MAX.
Right, yeah.
They need cash to address liquidity concerns and potentially avoid a credit downgrade.
Right.
We're talking about a share sale of nearly $19 billion.
Wow, that's a significant amount of money. Clearly they're feeling the pressure from this strike. And speaking of pressure, Bloomberg also reported that Volkswagen might be closing factories in Germany. What's going on there?
VW is facing declining sales and profits, especially with the rise of competition from Chinese rivals like BYD.
Okay.
They're considering closing factories as a cost-cutting measure to improve their competitiveness.
So even a giant company like Volkswagen isn't immune to the pressures of the global market.
Yeah,
It seems like no one is safe in this economy.
that's a good point. And on that note,
Yeah.
let's wrap up this part of our deep dive.
Okay.
We've covered a lot of ground, but there's still plenty more to discuss.
Stay tuned, folks, because when we come back, we'll be diving deeper into the potential impact of all this news on your investments.
Welcome back to the Pro Ticker Podcast.
Let's dive right back into our deep dive and explore how all this news could potentially impact your investment strategy.
Sounds good to me. Where should we start?
Well, we were just talking about the U.S. election and the economists' concerns about inflation, especially in light of some of Trump's proposed policies.
Right. The Wall Street Journal really laid out some potential hazards there. It's worth emphasizing that both candidates' proposals could have a ripple effect on your portfolio.
Absolutely. And speaking of ripple effects, I'd love to unpack the whole tariff issue a bit further. The Wall Street Journal mentioned it. But how would tariffs actually affect everyday consumers like our listeners?
Think of it this way. Tariffs are essentially a tax on imported goods. They can increase the prices of everything from clothing and electronics to car parts, as we mentioned before. It's like a hidden tax that quietly makes everyday items more expensive.
So tariffs could eat away at people's purchasing power without them even realizing it. That's concerning.
It is, and those higher prices can ripple through the economy, potentially leading to overall inflation, which further erodes purchasing power.
Okay, so let's say inflation does tick up. What does that mean for our listeners' investments? Are there any specific strategies they should consider?
Well, certain investments might become more attractive in an inflationary environment, things like commodities or real estate, which tend to hold their value when prices are rising. On the other hand, bonds might become less appealing because inflation erodes their fixed returns.
That makes sense. So it's all about adapting your strategy to the prevailing economic winds. Now let's shift gears a bit and talk about U.S. Treasury yields. CNBC reported that they are climbing. What's the significance of that?
CNBC highlighted their recent climb, and you'll recall our earlier conversation about the Treasury Department keeping debt sales steady. It's all connected.
Can you remind us how that works again? What does it mean to hold debt sales steady?
Sure, the U.S. government regularly needs to borrow money to finance its operations, and it does so by issuing debt in various forms, including Treasury bonds. These bonds are essentially IOUs from the government.
So when the Treasury sells more bonds, they're essentially increasing their borrowing.
Exactly, and the yield on those bonds reflects the interest rate investors' demand for lending money to the government. When yields go up, it means investors are demanding higher returns, which could indicate they see more risk in the economy.
So rising yields could signal a lack of confidence in the economy's stability.
It's one possible interpretation. Rising yields could also reflect expectations of higher inflation, as we discussed earlier.
This raises an important question. What happens if the Treasury needs to borrow even more money to cover those large fiscal deficits we've been hearing about?
Bloomberg suggests that increased debt sales could put even more upward pressure on yields, making it more expensive for the government to borrow.
And that could have a domino effect on other interest rates, right?
Uh-huh.
Like mortgages, loans, and even credit cards.
Exactly. It's a chain reaction worth paying attention to. Now let's circle back to our discussion about Japan and the weaker yen. Bloomberg mentioned something called the carry trade. Can you break down what that is and why it's relevant right now?
I was hoping you'd bring that up. It sounds a bit complicated.
It's actually a fairly simple concept. The carry trade is a strategy where investors borrow money in a currency with a low interest rate, like the yen, and then invest it in assets with a higher yield, like bonds in another country.
So they're essentially making a bet on the difference in interest rates.
Exactly. And with the yen weakening, it becomes even more attractive for carry traders to borrow yen and invest elsewhere. This increased demand for other currencies can further weaken the yen, creating a self-fulfilling prophecy.
But that sounds a bit risky, doesn't it? What happens if the yen suddenly strengthens?
That's the catch. If the yen strengthens, those carry trades can quickly become unprofitable, forcing investors to unwind their positions, which can lead to more volatility in the currency markets.
Sounds like a high-stakes game of hot potato. Now, I want to touch on McDonald's and that unfortunate E. coli outbreak again. CNN mentioned that their stock took a hit last week, which is understandable.
Yes, outbreaks like this can be devastating for restaurant companies. CNN's analysis highlighted the varying impacts of these events.
What are the key takeaways for investors in situations like this? How can they assess the potential damage?
Well, CNN pointed to Chipotle, which struggled for years to recover from their E. coli outbreak in 2015. But then there's Wendy's, which bounced back relatively quickly from a similar incident in 2022. So the key takeaway is that a company's response is crucial. Transparency, quick action, and effective communication can make all the difference.
So it's all about regaining consumer trust, which can be a long and challenging process.
Absolutely. Perception is everything in these cases. Now let's revisit Boeing and their massive share sale for a moment. Bloomberg pointed out that they are raising nearly $19 billion to address those liquidity concerns we talked about.
Right, that worker strike has really put them in a bind.
Yeah.
But what are the implications of such a large share sale? Could it backfire on them?
It's a valid question. Large share sales can dilute the value of existing shares. Imagine slicing a pie into more pieces. Each slice gets smaller. However, it can also provide much-needed cash for the company to navigate difficult times like this strike.
So it's a trade-off, short-term relief, but potential long-term consequences for shareholders.
That's a fair assessment. And finally, let's not forget about Volkswagen's potential factory closures in Germany.
Right. Bloomberg described it as a cost-cutting push to stay competitive.
Exactly. The global auto industry is incredibly competitive these days, and VW is feeling the heat from rivals like BYD in China. These factory closures, if they happen, would be a significant development not just for VW, but for the German economy as a whole.
It's a sobering reminder that the global economic landscape is constantly shifting, and companies need to adapt or risk falling behind.
That's a crucial takeaway for investors. It's more important than ever to stay informed and understand the forces at play in the markets. Well, that wraps up our segment on potential investment impacts.
Great, but before we wrap up the entire deep dive for today, there are a few more noteworthy news items we want to touch on. All right, before we let you go, we have a couple more interesting tidbits from the world of finance. Let's call this our other noteworthy news segment. What do you have for us?
Well, the Wall Street Journal highlighted Hyundai Mobis, the South Korean car parts supplier. Analysts are predicting some impressive shareholder returns for them this year.
That's interesting, especially considering all the challenges facing the auto industry right now.
Right, but Nomura analysts are forecasting Hyundai Mobis to return 25% of net profit to shareholders, a significant jump from last year.
So what's their secret sauce? How are they defying the odds?
It seems like they've been able to maintain profitability even with rising costs, thanks in part to their strong relationships with major automakers like Hyundai and Kia.
So a solid business model and strategic partnerships can really make a difference even in a tough market.
Absolutely. And speaking of strategic moves, Daiwa Capital analysts are expecting Kia's average carbon dioxide emissions per vehicle to drop significantly in 2025.
That's great news for the environment, but how does this translate into good news for investors?
Well, the European Union has strict standards for CO2 emissions, and car manufacturers face hefty penalties if they exceed those limits by reducing their emissions. Kia is minimizing their risk of incurring those penalties, which can be quite substantial. It's a smart move from both an environmental and a financial perspective.
A win-win situation for sure. Now, let's do a quick rundown of some other notable headlines. First up, Auckland International Airport in New Zealand. Macquarie analysts were expecting an upgrade to their FY 2025 earnings guidance, but that didn't happen.
It seems like there's some caution about the travel outlook over the next few months, particularly within New Zealand. The travel industry is still recovering from the pandemic, and it's been a bumpy ride.
Makes sense predicting travel patterns is still a bit of a guessing game these days. Now, last but not least, let's talk about SiteMinder, the Australian accommodation tech provider.
City analysts are a bit puzzled by their low operating expenses.
It seems like SiteMinder's headcount growth has been very modest this year, which is keeping their costs down. However, the analysts are wondering if this might be a sign of nervousness about their revenue outlook. So it could be a case of too good to be true. Low expenses are great, but not if they signal a lack of confidence in future growth.
Precisely. It's a classic glass half full, glass half empty situation. And that wraps up our other noteworthy news segment for today.
Great stuff. Well, it looks like we've reached the end of our Monday morning deep dive into the latest financial news. We covered a lot of ground today, from Japan's election results and their impact on the yen to the potential for rising inflation in the U.S. We even explored the strategic moves companies like Hyundai, Mobis, Kia, and SiteMinder are making to navigate these uncertain times.
It was quite a journey through the world of finance. The key takeaway, as always, is that the markets are constantly evolving, and staying informed is crucial for making smart investment decisions.
Absolutely. We hope this deep dive has equipped you with the insights you need to stay ahead of the curve. Remember, knowledge is power, especially when it comes to your financial well-being.
Couldn't agree more. Thanks for joining us on this deep dive.
We'll see you all tomorrow morning with new headlines from major financial magazines.